Welcome back to Centrelink Insider AU. We are continuing our series on investing and building wealth in retirement alongside our regular Centrelink and age pension content. Because your financial well-being in retirement is not just about what Centrelink provides, it is about the whole picture. If you are new here, subscribe right now because we are covering both the government entitlement side and the wealth building side of retirement finance every single week. And share this video with anyone you know who owns an investment property or who is thinking about buying one. Because the tax changes announced in the May 2026 federal budget change the investment calculations significantly, and most property owners still do not fully understand what has changed and what has not. Now, let us get straight into it. Let us start with the raw numbers, because this video is called "The Numbers Do Not Lie." And the numbers in 2026 are genuinely more interesting and more complicated than most of the headlines suggest. The national median dwelling value in Australia at the end of February 2026 stood at AUD $922,838, representing annual growth of 9.9%, according to Cotality's Home Value Index. Across the combined capitals, the median value reached AUD $1,014,401, reflecting annual growth of 9.6%, while combined regional markets actually outperformed the capitals, with dwelling values rising 11.1% year-on-year to a median of AUD $751,327. So at the national level, and looking backward, Australian property has delivered strong capital growth over the past year. That is the starting point, and it is an important one. Over the 12 months to the start of 2026, most Australian property markets were delivering returns that many other asset classes would struggle to match. But the backward-looking national number hides an enormous amount of variation and a forward-looking story that is considerably more complex. Let me break down what is actually happening city by city, because the differences in 2026 are as stark as they have ever been. Perth has been the standout performer of the current cycle. Analytics data shows trailing 12-month annualized growth rates of 14.1% in Western Australia as of February 2026, and KPMG's January 2026 forecast projects Perth house prices to lead all capital cities with growth of 12.8% for the full calendar year. The compound growth in Perth house values over the last 5 years approaches 90%. Those are extraordinary numbers by any measure. And while some analysts are flagging deceleration signals, with the trailing 3-month annualized rate already dropping to around 9.9%, the underlying fundamentals of strong local employment, population growth, and constrained supply continue to support the Perth market. Brisbane and Darwin have delivered similarly strong performances. KPMG projects Brisbane house price growth of almost 11% and Darwin at 10.5% for 2026. Propertyology's research confirms that Brisbane and Adelaide have maintained strong momentum through the current cycle, with compound 5-year growth approaching 90% in both markets. The Queensland market in particular benefits from continued interstate migration, a strong local economy, and a rental market that remains significantly undersupplied. Adelaide sits in the strong but moderating camp. KPMG projects Adelaide house price growth of 8.2% for 2026, but notes that affordability issues are beginning to emerge, which may temper demand and redirect some buyers to more affordable markets. Adelaide has outperformed many forecasters' expectations over the past 3 years, but the affordability ceiling is real and getting closer. And then there is Sydney and Melbourne, and here the picture is meaningfully different. ANZ research expects Sydney to see outright declines of around -3% and Melbourne -4% for 2026. These two cities have been the most rate-sensitive markets in the country throughout the current interest rate cycle, and with the Reserve Bank having delivered further rate increases in 2026, both markets have felt the impact most acutely. Sydney's position as the most expensive property market in Australia means that serviceability constraints weigh most heavily on buyers here, and recent data shows that lower quartile house values in Sydney rose 0.8% over a recent month, while upper quartile values fell 0.9%. This divergence within a single city highlights the complexity of making a simple statement about any market as a whole. Now, I want to be honest about something because it is important for making good decisions. The difference between KPMG's national forecast of 7.7% growth and ANZ Research's capital city forecast of 2.8% is not a data error. It reflects genuine disagreement among credible analysts about how the combination of interest rates, tax changes, and supply-demand dynamics will play out across 2026. Westpac has taken an even more cautious view, forecasting dwelling price growth to essentially stall flat on average across the major capital cities for calendar 2026, with Sydney and Melbourne declining. CBA expects house prices to be about 3% lower than they otherwise would have been, specifically because of the May 2026 budget tax changes, and forecasts growth of only 3% to December 2026. When credible major bank analysts, independent research houses, and specialist property analysts disagree this significantly, the honest conclusion is that the short-term price direction is genuinely uncertain, and anyone who tells you with confidence exactly where prices will be in 12 months is not being straight with you. What we can say with much more confidence is what the structural drivers of Australian property values look like over the medium and long term. And this is where the story becomes considerably more consistent across analysts. Australia's population is forecast to rise to over 30 million people by 2030, from around 27.6 million today. That is close to 3 million more people who will need somewhere to live. KPMG forecasts that new dwelling supply over the next 2 years will be around 30% below the national target set under the National Housing Accord. The structural imbalance between strong population growth and housing supply that is insufficient to meet that demand is real, persistent, and shows no sign of resolving quickly. Low resale supply has been a defining feature of the current cycle. Australia's population increased by 8 million over the last decade, while the total number of properties listed for sale decreased from 339,000 to just 228,000, a decline of 33%. The basic economics of supply and demand, applied consistently to Australian housing over many decades, have produced a long-term trend of capital growth that has broadly rewarded patient investors. Several decades of historical evidence shows that a standard Australian house has tripled in value or better in each block of 20 years since World War II, which implies an average annual growth rate of around 6% sustained over very long periods. Now let us move to the part of this discussion that is genuinely new and genuinely significant in 2026, and that is the federal budget tax changes that were legislated on the 12th of May 2026. Because these changes fundamentally alter the investment calculation for property buyers who purchase established residential properties after that date, and understanding them precisely is now essential for every property investor in Australia. The federal budget has introduced two major changes that directly affect property investment. The first is to negative gearing. The second is to the capital gains tax discount. Let me walk through each one clearly. On negative gearing, the government will limit negative gearing to new builds from 1 July 2027. From that date, investors who purchase established residential properties will no longer be able to deduct rental losses against other income such as wages and salary. Instead, losses will only be able to be deducted from residential rental income from other rental properties, or carried forward against capital gains when the property is eventually sold. Negative gearing for established residential properties will be abolished from 1 July 2027 for properties purchased after 7:30 p.m. on 12 May 2026. This is now law and is not subject to further parliamentary change. There are several critically important nuances here that most people have not understood correctly. First, existing property owners are grandfathered. Properties held at 7:30 p.m. AEST on 12 May 2026, including those already under contract awaiting settlement, are entirely exempt from these changes and can continue to be negatively geared under the current rules indefinitely until sold. If you already own an investment property, your tax position has not changed. Second, new builds are also exempt. Eligible new build residential properties retain both negative gearing access and the existing 50% CGT discount. Properties in widely held trusts and superannuation funds are also exempt from the changes, as are targeted exemptions for build-to-rent developments and private investors supporting government housing programs. Third, for established properties purchased after budget night, the change does not eliminate the tax benefit entirely, it delays and restructures it. Losses can still be carried forward and used against future residential rental income or against capital gains when the property is sold. The practical impact is that the annual cash flow advantage of negative gearing for new, established property purchases is eliminated, and lenders may no longer include these tax savings in their serviceability calculations. According to one analysis, this could reduce borrowing capacity by up to 30% for affected investors. On capital gains tax, the changes are equally significant but do not take effect until 1 July 2027, and they only apply to capital gains that accrue after that date. The government will replace the 50% CGT discount for individuals, trusts and partnerships with cost-based indexation and a 30% minimum tax rate on capital gains from 1 July 2027. This means investors will only pay tax on their real capital gain adjusted for inflation, rather than receiving a flat 50% discount on the nominal gain. For long-term investors in high inflation environments, cost-based indexation can actually be more favorable than the 50% discount. In a low inflation environment, the 50% discount would have been superior. At current inflation rates of around 2.5%, the two approaches produce broadly similar outcomes over typical holding periods. CBA describes the combined effect of these changes as expected to make established investment properties less attractive, with house prices about 3% lower than they otherwise would have been, and that removes investor demand from established properties toward new builds, supporting construction activity particularly for apartments where investor pre-sales are important. Now, the question I want to address directly is this: given everything we have covered, is property still a good investment in Australia in 2026? And my answer is that it depends on three specific questions, and the answer to each determines whether property makes sense for your situation. The first question is what you are buying and when you are buying it. If you already own established investment properties purchased before budget night, your position is actually stronger than it might initially appear. Existing investors are grandfathered, meaning your negative gearing and your 50% CGT discount continue to apply. Existing property owners may actually be less inclined to sell, because doing so would mean losing the grandfathered tax benefits, creating what CBA describes as a lock-in effect. This lock-in effect means established property supply could remain constrained, which supports prices for existing properties over the medium term even as new buyer demand is affected by the changed tax rules. If you are considering buying a new, established residential investment property after budget night, the investment case has changed materially. Without the ability to use rental losses to offset other income, the cash flow burden of carrying a negatively geared property becomes heavier. This does not make established property investment impossible, but it does mean the investment thesis needs to be built on genuine medium to long-term capital growth expectations and rental yield, rather than on tax-driven cash flow management. Investors who currently own a negatively geared residential property can continue to enjoy the tax benefits described above. Those now unable to take advantage of these benefits face a genuinely different investment environment. If you are considering new build property, the picture is different again. New builds retain both negative gearing access and the 50% CGT discount under the new rules. The government has specifically designed this to redirect investor demand from established housing stock toward new supply. For investors who are comfortable with the higher upfront costs and the risks associated with new developments, including construction delays, developer insolvency risk, and the possibility that new builds come to market in locations with supply imbalance, new builds now occupy a more advantageous tax position than established properties for investors purchasing after budget night. The second question is which market you are entering. The difference between Perth and Melbourne in 2026 is not a matter of degree, it is a matter of direction. Perth and Brisbane offer ongoing fundamental support from population growth, constrained supply, and strong local economies, with KPMG forecasting double-digit growth in Perth. Sydney and Melbourne face genuine headwinds from affordability constraints and rate sensitivity, with ANZ expecting outright price declines in both cities for 2026. Investing in Australian property without specifying which market and which price point is like saying you are investing in Australian shares without specifying which company. The variation within the national average is enormous, and the average itself tells you very little. The third question is your investment time horizon and your specific financial position. Long-term historical evidence that Australian house values have tripled in value or better every 20 years since World War II applies to the market in aggregate over very long holding periods. It does not guarantee any specific property in any specific location will perform in line with that long-term average. For investors with a genuine long-term horizon of 10, 20 or more years, the structural fundamentals of population growth, undersupply, and wealth accumulation continue to underpin the long-term case for well-selected Australian property. Some economists predict 40 to 50% growth in Australia's house prices between now and 2030 based on population projections and supply shortfalls. Strategic investors who buy investment-grade properties and hold them for the long term will continue to outperform. For investors seeking to flip properties quickly or who need positive cash flow from day one under the new tax environment for established properties, the 2026 landscape is considerably more challenging than it was 12 months ago. Now, let me also address the rental market, because rental income is an important part of the total return calculation for property investors. Australia's rental market remains structurally tight. National rental listings are reportedly about 11% lower than a year prior and 17% down on the previous 5-year average. Low supply continues to drive up rental rates across the country. Nationwide rental inflation was 3.9% in January 2026, down from 5.8% a year prior, and its peak of 7.8% in August 2023, but still elevated compared to the long-term average of 3%. KPMG projects annual rent growth of around 3.5% through 2026 and 2027. For investors relying on rental yield to sustain the cash flow position of their property without the negative gearing tax benefit, persistent rent growth helps. The rental market tightness is real and driven by structural factors, including population growth that has outpaced new dwelling completions for several years, and this dynamic is expected to continue even as migration slows and construction costs gradually stabilize. Now, I want to compare property to other investments briefly, because looking at property in isolation misses the full picture of what a retirement investor is choosing between. When you compare Australian property to other asset classes over different timeframes, several things stand out. Superannuation balanced options have returned approximately 7% to 9% per year over the past decade for major industry funds, with the ART Core Strategy MySuper option returning 7.9% per annum over 10 years and around 8.4% in the most recent financial year. These returns are achieved without the leverage that property investors typically use, without the illiquidity of real estate, and without the ongoing management burden of tenants and maintenance. Index funds tracking the ASX 200 have delivered long-term annual returns of around 9% to 10%, including dividends over extended periods, and can be accessed with minimal ongoing cost and complete liquidity. Term deposits and high-interest savings accounts currently offer rates of approximately 4% to 5%, with zero investment risk. These are not trivial alternatives. The traditional argument for property over these alternatives has rested on 3 pillars. First, leverage. Since you can borrow 80% or more of the purchase price of a property, meaning a 10% price increase on a $900,000 property generates a $90,000 return on a $180,000 deposit, which is a 50% return on your actual capital invested. This leverage effect does not apply to superannuation or index funds. Second, negative gearing, which reduced the effective cost of holding a property that is not covering its own costs from rental income alone. This pillar has now been significantly weakened for new established property purchases after May 2026. Third, CGT discount, which halved the tax on capital gains after a 12-month holding period. This pillar remains in place for properties held until 1 July 2027, after which it is replaced by indexation for all investments made after budget night. The leverage argument remains the strongest case for property investment even in the changed environment of 2026. No other asset class available to retail investors allows you to control such a large asset with such a modest deposit, while the income from that asset helps service the borrowing costs. The new environment simply means the tax-subsidized shortfall between rental income and holding costs is no longer available as a mechanism for managing the cash flow burden of leverage. The investment must be capable of generating genuine long-term capital growth and eventually positive cash flow from rental income alone, without relying on the tax system to subsidize the gap between the two. Now let me bring everything together with a practical framework for thinking about property in your retirement strategy in 2026. The first consideration is what you already own. If you own established investment properties purchased before 12 May 2026, you are grandfathered, and your tax position is unchanged. The lock-in effect of grandfathering means supply of established properties may remain constrained as existing investors hold rather than sell, which is a potential support for prices. If you own your primary residence and are wondering about the value of investing in an additional property, the new tax environment requires a more careful cash flow analysis than before. The second consideration is whether new builds make sense for your situation, given that they retain both negative gearing and the 50% CGT discount. The case for new builds has strengthened relative to established properties under the new rules, but new builds come with their own risks, including construction delays, developer risk, and the possibility of entering a market at a time when the area is experiencing significant new supply. The third consideration is which market you are targeting. The variation between Perth and Brisbane on one hand and Sydney and Melbourne on the other is currently so large that city selection is at least as important as the asset class decision itself. Regional markets have outperformed capital cities over the past year and continue to offer the combination of lower entry prices and solid fundamental support that many analysts believe will sustain above average growth rates. The fourth consideration is your personal tax situation. The negative gearing changes affect investors differently depending on their marginal tax rate, their level of leverage, and their rental yield. The effect is largest for investors with high marginal tax rates, high leverage, low rental yields, and high interest expenses. If you have a lower income or lower leverage, the impact of losing negative gearing against other income is smaller. Understanding your specific position requires a proper financial analysis, not a general rule of thumb. The fifth consideration is how property fits into your overall retirement strategy, alongside superannuation, cash, shares, and potentially the age pension. For many Australians in the retirement planning phase, the practical question is not whether property is a good investment in the abstract, but whether adding more property exposure to a portfolio that may already include a primary residence makes sense given the concentration of risk that implies, and whether the capital that would be used for a deposit might generate better risk-adjusted returns in a different form. And the sixth consideration is that the residential property investment landscape after the May 2026 budget has diverged significantly between two types of investors. Existing investors with grandfathered properties are in a position of relative advantage, holding assets whose tax treatment is protected and whose supply will be constrained by the lock-in effect. New investors in established properties face a materially different cash flow challenge and need to construct their investment thesis on the fundamentals of long-term capital growth and rental income rather than on tax-driven cash flow management. So, is property still a good investment in Australia in 2026? The numbers say yes for long-term investors in well-selected markets who understand the changed tax environment, who are not relying on negative gearing to make a loss-making property viable from a cash flow perspective, and who have the holding capacity to ride through short-term volatility. The numbers say be cautious for investors in Sydney and Melbourne who are entering at near peak prices in markets facing near-term headwinds from rates and affordability. And the numbers say the game has changed significantly for anyone entering established property investment after May 2026, specifically because the tax subsidies that made negatively geared property viable for millions of Australians are being restructured in a way that makes the after-tax cash flow position of new established property purchases materially more challenging. Property in Australia has a long and broadly compelling investment track record. That track record was built in a specific tax environment that no longer fully applies to new investments. The structural fundamentals that have underpinned that long-term track record, population growth, housing undersupply, and Australia's continued wealth trajectory remain intact. What the 2026 budget has done is separate the investors who have built their case on genuine long-term fundamentals from those who have built it primarily on the tax system. The first group should be confident. The second group has a new analysis to do. If this video helped you understand what is actually happening in Australian property in 2026, please give it a thumbs up, because it genuinely helps more Australians find this information when they need it most. Drop a comment below and tell me whether you own investment property and how the May 2026 budget changes have affected your thinking. Subscribe to Centrelink Insider AU because we are here every single week covering both the government entitlement side and the wealth building side of retirement in Australia. And share this video with any property investor you know, because the changes that came into law in May 2026 are genuinely significant and most investors still have not fully worked through what they mean. Until next time, stay informed, stay protected, and take care of your financial future.